Okay, let's dive right into this. Welcome to today's explainer. Today, we're stepping directly into the shoes of a professional equity analyst. We're going to conduct a really rigorous, forensic stock valuation of a company that's honestly puzzling a lot of investors right now, and that is Compass. We're going to take their raw financial data, cut through all the noise, and use standard institutional models to figure out what this real estate tech company is actually worth.
So here's our roadmap for this explainer. First, we'll look at the Compass Enigma. Then, we'll dive into absolute valuation using the DCF model, followed by DDM and residual income. After that, we'll look at relative valuation using their peers and asset-based valuation looking at NAV. Finally, we'll wrap it all up with the final intrinsic value.
All right, Section 1, the Compass Enigma. Unprofitable on paper, but flush with cash.
Now, before we can even begin to value a business, we have to understand the friction at its core. I want you to keep this number in your head, $7.06. That's the last closed price of Compass stock. Everything we calculate going forward is in service of answering one really simple question. Is $7.06 undervalued, overvalued, or perfectly priced?
And this brilliantly illustrates exactly why valuing this company is so incredibly tricky. On one side, we've got a massive top-line trailing 12-month revenue of almost $7 billion. But look at the other side. Their net profit margin is negative 1.30%. I mean, they are moving literal billions of dollars in real estate, but when it comes to standard accounting profit, they're losing money.
Let's look a little deeper at this paradox, because it gets weirder. Their trailing net income is negative $58.5 million. Because of that, their traditional price-to-earnings ratio sits at a completely meaningless negative 70.60. But wait, look at their free cash flow. They generated over $203 million in pure cash over that exact same period. They're taking in way more cash than their income statement suggests. So standard PE ratios, absolutely useless here. We need better models.
Moving on to Section 2, absolute valuation, the DCF, finding intrinsic cash value. Because earnings are negative but cash is actually positive, we're firing up the absolute gold standard of valuation, the discounted cash flow model, or DCF. Just to make sure we're all on the same page here, we are looking at free cash flow to the firm. This is the actual cash the business can distribute after it pays for everything it needs to keep running. And for Compass, over the last 3 years, this metric has grown at a massive compound annual growth rate of 36.79%. We absolutely have to capture that value.
Now, time for a little analyst transparency. A DCF model requires projecting future cash flows and discounting them back to today's money. Since our source documents don't provide a predefined weighted average cost of capital, or WACC, we have to make some sensible, standard assumptions to actually move forward. So we're plugging in a discount rate of roughly 10% to account for market risk and a conservative perpetual terminal growth rate of 2% for when their high growth phase finally stabilizes.
Okay, so the crucial point is really in the math here. When we start with their $203.3 million in cash flow, project it out using historical trends, and discount it back at our 10% rate, it aligns perfectly with the source data stated fair value price of $7.23 per share. Against our current price of $7.06, that leaves a trainee 2.30% margin of safety. Basically, the cash flow strictly justifies the current price tag.
All right, Section 3, DDM and residual income, evaluating equity and returns.
So we've looked at the cash generated by the firm as a whole. Now let's run 2 more absolute valuation models to see how the equity holders themselves are being directly rewarded. One of an analyst's absolute go-to tools is the dividend discount model, or DDM, where we forecast and discount the future dividends a stock will pay you directly. So what does that look like for Compass?
Well, it looks like a big fat zero. The dividend is exactly zero. The historical dividend CAGR is zero. You see, Compass is a growth stage tech company hoarding its cash to scale, right? It's not a utility company paying out quarterly checks. So the DDM model, it's completely inapplicable here. We just have to toss it out.
Since DDM failed us, we turned to the residual income model. The logic here is pretty straightforward. Step 1, we start with the current book value of equity. Step 2, we add the present value of future residual income, which is really just net income minus a charge for the cost of equity. Then Step 3, discount it back. But here's the massive catch for Compass. Their return on equity is a severely negative 7.48%. Because they are currently destroying equity value on a strict accounting basis, this model brutally punishes their valuation, basically suggesting they're worth far, far less than their current price.
Let's move to Section 4 and see how this builds. Relative valuation, the peers.
pricing against the market. We're pivoting now from absolute intrinsic value based on cash to seeing how the broader market is pricing Compass relative to its peers. Just to be totally transparent again, our raw data doesn't explicitly list competitors, so we have to construct a reasonable peer group ourselves. We're benchmarking Compass's multiples against similar publicly traded tech-enabled brokerages, like Redfin or Anywhere Real Estate, just to give our relative valuations some actual context. When we look at these relative multiples, the story is incredibly split. Their enterprise value to EBITDA is sky high at 60.12. That's a steep premium compared to standard brokerages. But look at their price-to-sales ratio. It's just 0.76. The market is literally letting you buy $1 of Compass revenue for 76 cents. And their forward PE flips positive to 14.71, showing the market fully expects them to become profitable very soon. It's a really wild mixed bag of value and premium pricing. All right, Section 5, Asset-Based Valuation, NAV, Valuing the Balance Sheet. This lens asks a pretty blunt question. If operations stopped completely tomorrow, what are the bare assets of the company actually worth? And we can reverse engineer this right from our data. Step 1, we identify their price-to-book ratio is 5.09. Step 2, we note their total market cap is $5.257 billion. Step 3, by dividing the market cap by the price-to-book ratio, we reveal a baseline book value of roughly $1.03 billion. When we divide that by the implied shares, we get a per-share value that is significantly lower than our current $7.06 price.
Now, what's really interesting about this is that their enterprise value to assets ratio of 3.30 tells the exact same story. Asset-based valuation sets a floor, sure, but it's a very low floor. The market is pricing Compass significantly higher than its mere liquidation value, mostly because Compass is an asset-light tech company. They trade heavily on their software and those future cash flows, not on owning hard assets like real estate itself. Finally, Section 6, the final intrinsic value, the analyst's verdict.
All right, it's time to pull this all together and synthesize our 4 major valuation models into one cohesive verdict. The asset-based and residual income models yield really low values, but we have to assign them low reliability because Compass is an asset-light company with currently distorted negative earnings. The relative multiples? Well, they're mixed. Therefore, our highest reliability weighting absolutely goes to the DCF model. Given the company's fantastic $200+ million in free cash flow, the DCF provides our most reliable true north at $7.23 per share. Which brings us right back to where we started. With a current market price of $7.06 and an intrinsic DCF value of $7.23, the stock is trading just beneath fair value. That difference reflects a really tiny 2.30% margin of safety. As an analyst, this doesn't signal some deep undervaluation or massive overvaluation. Instead, it indicates the stock is currently being priced quite fairly by the market right now based on its cash generation. So what does this all mean? I leave you with this final thought. We've done the math, and the valuation rests entirely on how you view their cash versus their earnings. Is the market's current pricing of this unprofitable yet high cash flow real estate tech company a trap? Or is it a hidden treasure waiting for earnings to flip positive? Well, that's for you to decide. Thanks so much for joining me on this explainer, and keep your analyst hats handy for the next one.